Welcome to the Allan Small Financial Show. As I always like to say, thank you all for taking some time out of your busy day to share it with us. We have an information-packed show today, a lot of information on the markets and explaining what's actually going on at this point in time. I know a lot of individual investors are probably taking some time off over the next 4 to 8 weeks, going up to their cottages or their summer residences. And before you go, I'm sure you have a lot of questions about what's going on out there. Are we going to see some more interest rate hikes? What is the Federal Reserve? What is the Bank of Canada saying? A lot of you have a lot of questions on your mind that I get on a daily basis. So as I always say, this show is to answer those questions, clarify or clear up some of the misconceptions that exist out there for investors. And we have, as I said, information overload today on the show. Let's take a look at our topics for the show today. The Magnificent Seven. No, it's not a movie or a TV show. Magnificent Seven is a phrase that has been created to describe some of the biggest companies in the world today and how they're performing and their effects on the market. We'll speak about that. As always, we go into our This Week segment, and the This Week segment discusses what I believe individual investors need to know over the next few weeks before you make your investment decisions. Retail versus institutional investors. What is an institutional investor? What are the differences? And how have retail investors fared as compared to institutional investors for the first 6 months of this year? Markets at the halfway point. Where do the indices sit? What indices are higher in North America? Which ones are struggling a little bit? And, can we still compare our portfolio performance to the performance of these indices? Does that still make sense? We'll touch on that. China and what it's doing right now to stimulate growth. They're actually cutting their prime lending rate, whereas many countries around the world are actually increasing their lending rates or increasing interest rates. China is cutting so that they can improve their struggling economy. Bank profitability. How are the banks doing? We just got word that the banks are going to have to set aside even more money on the sidelines, on their shelves for a rainy day in case we see more defaults down the road. How is that impacting bank performance? Are they as profitable as they have been? And lastly, your questions. I get a lot of questions throughout the 2 weeks from show to show, but I'd like to hear from you during the show. So if you have any questions, please put them in the chat box. I'd love to answer them at the end of the show. I always take a few questions that I get throughout the 2 weeks, but if we could get some questions during the show, that would be fantastic. I know a lot of you watching the show have questions, so please don't hesitate. Don't be shy. Put those questions out there. I would love to answer them. So without further ado, let's get on with the show. The Magnificent Seven. So what are the Magnificent Seven stocks that I'm talking about? Well, these stocks are the biggest companies in the world, and most of them are in the technology space, and we all know who they are. Alphabet, formerly known as Google, Amazon, Apple, Meta, formerly known as Facebook, Microsoft, Nvidia, and Tesla. Tesla may not be a tech stock for some, maybe more of a car company, but they also do a lot of and have a lot of technology in their products. So what's going on right now, and why are people concerned about the Magnificent Seven? Well, over the past 6 months, or the first 6 months of this year, these companies that have taken the index, the S&P 500, the NASDAQ, powered these indices to high returns. The NASDAQ is up almost 30% year to date. The S&P 500 up about 14% year to date. And this is on the back of these 7 stocks. And we have probably the best chart that I have for this show up front here, talking about how the Magnificent Seven has led this market significantly higher. And this chart pretty much says it all, right? You have Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia coming up with 53% of the market's returns. Take a look at the S&P 500. The rest of the S&P 500, 493 companies, they're up basically just slightly. I would say maybe 1 or 2%. It shows here a bit of a flat line. The S&P 500, when we took this chart, was only up 11. It's actually up a few percent higher today. But overall, you can clearly see that the markets are moving higher on the back of these 7 stocks. Now, is this healthy? I've been asked on TV and radio, is this a healthy market if it's pretty much moving because of 7 stocks? I guess the answer is no. You want to see a broader base. You want to see more stocks participating, more sectors participating in the growth. However, my comment to that then is, how often do you see all sectors moving higher? We get it sometimes where 495 stocks on the S&P 500 are moving higher, or sometimes we get 495 stocks moving down on the S&P 500 out of 500 names. So sometimes we get a broad-based move, but for the most part, the move has been, at least for the last many years now, based on the largest companies, the big tech names, the trillion-dollar club, as I like to call it, the Microsofts, the Apples, the Nvidias now just hit a $1 trillion market cap. And these are the names that are powering us forward. A lot of it has to do with artificial intelligence, and we are seeing this with respect to tech names incorporating artificial intelligence in their press conferences, in their business models, and what they're saying. So no, it's not a healthy economy when we're just dependent on maybe 7 or maybe even 8 or 10 names to power us forward. I know some people are calling it the Elite 8 because they're counting actually Netflix in there. I like to keep it the Magnificent 7. I think it sounds even better that way. But overall, no, it's not healthy. But I think instead of being afraid or being concerned, I think you want to own some of these names. And I've said this for years now. I think every investor, if you're looking for growth and can handle volatility, should own a couple of these names to help power your portfolio forward, especially if you're looking for growth. So instead of complaining or being upset of the way the market is behaving, a lot of savvy investors have been talking about it. I think you want to own some of these names. Don't be afraid to own an Amazon or a Microsoft or a Meta. Embrace what's going on and use it to your advantage, because this Magnificent 7 could be with us for quite some time. We've seen it over many years leading into this year. And now, with the AI push, we could see these names powering the markets for many years to come. Now's the part of the show where I talk about what I believe individual investors, all of you, should be focused on before you make your investment decisions over the next, let's call it 5 to 10 business days. Here we are once again talking about Fed speak. And yes, we've had this on our list many times, kind of went away from it for a little bit there, and now it's back at the top of our list. What is the Federal Reserve saying? What is Jerome Powell saying? He was actually being interviewed this morning. I saw his interview with some of the other areas of the world or countries of the world, like the head of the Bank of England. I saw head of Bank of Japan was there. ECB was there as well. And obviously Jerome Powell representing the United States and the Fed. What did Jerome Powell say? That affected the markets even as most recent as this morning. But what did he say last week when he testified up on the Hill in front of Congress? What did he say about the markets and where interest rates are going? Second thing I think individual investors need to focus on is market valuation. And we've had this on our list, but maybe not market valuation with respect to the whole market. I want to focus on the tech sector specifically. We've been hearing the word bubble pop up recently. Is this true? Are we in a bit of a tech bubble right now? And lastly, or the third point, let's focus on the positivity amongst or in the midst of all this negativity. There are a lot of negative data out there and information out there, but there's a lot of positive as well. And I think before you make your investment decisions, you need to take a step back and focus on the positivity, not as much on the negativity. So let's get to the first topic, which is Fed speak. And as I said, Jerome Powell, let's say last week, spoke in front of Congress, and he surprised the markets. Why did he surprise the markets? Because he said we could see as many as 2 more rate increases in the United States before the end of the year. He said that the how quick they raise isn't as important as raising itself. And the market, in my opinion, had priced in pretty much the fact that the Fed would be at the end of the interest rate hiking cycle by the summer. And when he said that we could see a rate increase in July, maybe another one in the fall, that took the market by surprise, and the market reacted negatively. We saw the first negative week for the NASDAQ, for example. We saw another negative week for the Dow Jones, and the TSX didn't fare too well as well, based on this notion that rate hikes were not over and that we could see even a higher Fed funds interest rate coming up, I guess, over the next 6 months. We have a few charts here that I think are really good to point out. The first one is the U.S. Consumer Price Index. This shows us where we sit right now with the inflation rate in the U.S. And obviously, the Federal Reserve is raising interest rates to combat inflation, to bring it down. You could see that inflation has now fallen to 4% in the U.S., down from 9% about a year and a half or so ago. And you can see that the core rate of inflation is still stubbornly high at 5.3%. What is the core rate? Well, it is the rate of inflation once you strip out volatile food and energy or oil prices. And that is really what the Fed is focusing on, this core inflation. And as I've said many times on our show, it's the core that's most important. And what has brought down the rate of inflation, in my opinion, has been the low energy costs, people coming back into the labor force. These things have been more important. Also, the supply chains, the bottleneck, that's pretty much disappeared now. We're now getting goods shipped all over the world a lot more freely. So these things have done a lot to bring down the rate of inflation. Not so much, or not as much, this rise in interest rates, but the Fed seems to think they need to continue to do this. The next chart that we can show here, which shows the federal funds target rate since 2006. You can see how high interest rates have spiked back to 2006, 2007 levels. You're looking at a 5.25% rate, obviously much higher than the inflation rate in the US, which is 4%. Usually once that target rate by the Fed is above the inflation rate, the Fed, you would think, would stop raising rates. Not the case, because core is still 5.3%. But you can see what a spike we're seeing with that rate there. And next chart we've shown many times, shows all the interest rate increases by the U.S. Federal Reserve. And again, we focus on the Federal Reserve even more so than the Bank of Canada, because this is a show where we talk about the stock market, where we talk about investing. And the investment markets tend to follow the Federal Reserve a lot more than they follow the Bank of Canada. However, because we are living in Ontario, in Canada, many of us in Toronto, I want to show the Bank of Canada's overnight interest rate versus the inflation rate to end off our illustrations here. And you could clearly see how much inflation has come down in our country. We just got a reading the other day, brought us down to 3.4% on the inflation rate. We have a Bank of Canada rate, a bank rate of well over 4%, almost 4.75. There's talk that the Bank of Canada could raise rates again coming up in July. If they do that, that would take more than likely our prime rate. So the prime rate is the rate that the banks provide all of us that want to borrow from the banks, well over 7%. Right now it's 6.95. Prime rate could go to 7.2%, a rate we have not seen in many, many years. So you can clearly see that interest rates are on the rise. And even though Federal Reserve looks to be, or leaning towards, more of a hike coming down the road, we need to keep an eye on that. We need to keep an eye on that if we're going to make good investment decisions. Second topic that I had on our list with respect to what I believe individual investors should focus on are market valuations, and in particular, tech stocks. To me, all I've been hearing is about how tech stocks are doing so well. And many people have been talking about this idea of a tech bubble, that perhaps artificial intelligence are leading us towards a tech bubble that will possibly burst, very similar to what we saw back in the late 90s. And I have a few charts. Some of them we've seen in the past. Our first chart here is NVIDIA. You can see how much NVIDIA has gone up. We've had this chart up many times. I think NVIDIA had a high of somewhere around $430 not too long ago, back down towards that 410, 414 mark. Broadcom, a chart of our stock, another chip company, semiconductor. You can see how well Broadcom, and the slope of that curve is even steeper than NVIDIA, which is quite amazing as well. And I guess the last chart I have here is a chart for an ETF on artificial intelligence, or what we call robotics. And it's an ETF that shows how well all these companies that are in this ETF or in this index have done. And you can see if you own the ETF, you'd be doing fantastic. You would have probably made somewhere around 60% return in a very short period of time. And that has caused many people to talk about valuation, talk about how this part of the market could be in a bubble. So the one comment I'll make about that is I don't like trying to figure out whether it's a bubble or not, but keep in mind, this is not like what we saw in the late 1990s. You know, back then I was a new investment advisor, just came out of advisor school. So, you know, I've been doing this now for over 25 years. So I was in the first few years that I was out into the investment world, helping individuals with their portfolios. And what I was getting are calls to buy these .com companies, bid.com or this.com or that.com. Most of these companies had no earnings. Most of these companies were built on really no foundation at all, a house of cards, basically. And once you remove a card from the bottom of that house, what happens? The house comes tumbling down. And we saw that in the late 90s. Unfortunately, it took down, or that tech bubble bursting, unfortunately took down one of our biggest companies in our country, Nortel, if many of you remember that. But this is nothing like that. The companies that make up the Magnificent Seven, or a lot of the companies that have moved higher based on this idea of artificial intelligence, they have earnings. They have a lot of earnings. These are some of the largest companies in the world, the Apples, the Microsofts, the NVIDIAs, the Googles, the Metas, et cetera, et cetera. These aren't companies that just rely on artificial intelligence. They're relying on artificial intelligence to make what they do even better. Amazon is another name that comes to mind using artificial intelligence. And they've been using AI for quite some time. So please don't get caught up in this hype about bubbles bursting and tech bubbles bursting. I just don't see it right now. To me, these companies will continue to move higher. How fast and at what rate is the question. You know, right now, some of them are stretched. Some of their earnings have yet to match how fast the stock price has moved higher. So perhaps you want to maybe take a break from some of those names and move into some of the names that are a little cheaper. But overall, I think market valuations for many names are actually pretty good, and you should consider owning them if you're looking for growth names. The third topic and last topic that I have for all of us to consider before we make our individual investments over the next couple of weeks is this idea of focusing on the positive. There are a lot of negative points out there right now. Higher inflation, higher interest rates. Most of us are seeing the interest we're paying on our mortgages skyrocket, up 30%. We're seeing price of groceries up 9% in Canada. These are things that are obviously eating away at the income that we bring into our households. A lot of negativity there, and a lot of people don't see that getting better, even though we're seeing the headline inflation number come down. But I think for stock market purposes and for investment purposes, we need to focus on the positive. What are the positives? Well, a resilient economy. We're seeing the economy still showing positive growth. By now, most of us, or most investors, or most analysts, economists, thought we would already be in a recession, and we're not. We're also seeing retail sales numbers hanging in there, positive numbers. In Canada, we're seeing retail sales numbers better than most of the G7 nations. Even in the United States, we're seeing positive numbers on retail sales. The economy continues to move forward, even in the face of adversity, even in the face of higher interest rates and higher inflation. And to me, that is what we need to focus on. So before you go make your investment decisions, focus on the positive. Don't let the negative get you down. And a chart we have here, just a simple chart of the S&P 500, clearly shows you that if everything was so doom and gloom, how would the S&P 500 be up 14% year to date just after 6 months? So continue to focus on the positive. Try and stay away from the negative, even though it may be all over the place in the media, on social media, throughout the internet. Focus on the positive. Focus on the glass being half full, and focus on what you can do with your money and where you can invest it to get most bang for your buck. often see or hear about this comparison between the retail investor versus the institutional investor. And we always hear that the institutional investor is the savvy investor, right? They're the investors that are getting out when all the retail investors are just figuring things out and getting into the market. They're escaping or selling a stock when all the retail investors are seeing the stock all over the media and perhaps buying. So I thought first we would define what the retail investor is versus what an institutional investor. And probably the simplest way to do that is a retail investor is the average Joe walking the street, the person who invests their money into their own RSPs, does their own investing, trying to get ahead, trying to improve or grow their wealth so that they can live a great retirement or provide provide the funds needed for their children to go to university or college or really whatever their goals may be. So the retail investor is the average person who invests for themselves. Institutional investors, the best way to, I guess, to define them is an entity or a person that invests for somebody else. Hedge funds, mutual funds, savvy traders, investment advisors. These are individuals that are called usually savvy investors. These are the people or institutions that invest for others. And it's interesting because coming into this year, we all look at these institutional investors as knowing what they're doing, always seem to have the right answers, getting in and getting out before the retail investor, even catches on to what's happening. But have the institutional investors gotten it right this year? Strangely enough, the answer is no. Coming into this year, institutional investors or the savvy or the smart money was betting on things such as oil. I remember start of January, all I heard about is how the smart money was buying oil companies, that oil was going to go back up to $90 to $100 a barrel based on a number of factors, geopolitics, Russia, Ukraine, China, et cetera, et cetera. Well, that didn't play out. And in fact, what did play out was retail investors and a lot of money going into other sectors of the market, the sectors that were most beaten up last year, in which the institutional investors didn't even want to touch, like technology. And I think that's why tech has done so well this year, because it caught a lot of people by surprise. And that to me is something to note, that not always do the institutional investors have the right answers or all the answers. And so what can retail investors do to compete with the institutional people? Well, number one, I think a good strategy is to be a contrarian, to buy when those are not buying, to be greedy when those are fearful, as Berkshire Hathaway or Warren Buffett says. You want to get in when those are exiting, and you want to get out when those are getting in, because that's what the savvy investors do. That's what the institutional investors do. And that's what I think all investors should do if you're looking for growth. The other thing I think retail investors can do is get some help. They can get some help by hiring an investment advisor. I'm an investment advisor, senior investment advisor, the Allan Small Financial Group. As I said, I've been investing money or helping people invest their money for over 25 years. And I have a chart here which shows how well individual investors do when they take on the help or some of my financial advice. And this chart is very interesting, and you can see right away, very easy to see the differences. So on the far left, you have the difference. This is from 2014 to 2018. And you can see if someone does not have an investment advisor, they work alone, they decide what their portfolio looks like on their own, you can see how much they grew in those 4 years, about 42.6, $42,600. And you can see here, 41.8 if you had, an FA to start, but fired your FA or no longer used a financial advisor at the end. You can see how much your portfolio grew there, or portfolios of people grew there. Then you start to get to, okay, well, what if you didn't have a financial advisor at the start and you took on a financial advisor later on in those 4 years? Well, you could see you had double the growth of the other two. And lastly, what happens if you had an investment advisor, financial advisor throughout the whole 4 years? Well, you showed the most growth by far. So this clearly shows that if you're looking for help, if you're looking for advice, if you're looking to compete with the savvy investors, compete with the institutional investors, well, maybe you just need to take on a savvy investment advisor to help you make those difficult decisions. Because one of the things that investment advisors can do for you is take the emotion out of investing. A lot of us are very emotional when it comes to our money, our savings, our life savings, growing our wealth. And so sometimes you get married to a stock. I know many people, for example, are married to Apple. And I can tell you, in my opinion, Apple is a name today that I think is fairly valued. Will it go up over time? Perhaps. But I think it's fairly valued. And I think there are better names to own than, say, and than a name like Apple. So investment advisors can help. And I think they can help the retail investor compete or grow your portfolio over time to take on or compete with the savvy investors or the institutional investors over the years to come. So the market's at the halfway point, and wanted to bring this up because I think it's always good to take stock out of, what we're seeing, what's going on with the markets at the halfway point, and we're almost there, right? We're in the last week of June. Halfway point will be this Friday, and so where do the markets sit? And I took some notes here where the individual indices, the largest indices in North America sit. So at the top of the list, and I've mentioned it earlier in the show, is the NASDAQ, right? Up 27.5%. NASDAQ made up of, well, what do you know? What do you guess? Tech stocks, right? A lot of the big tech names are part of the NASDAQ, helping drive that indice a lot higher. Just comparing it to last year, the NASDAQ actually had about a negative 30% return last year. And just at the 6-month mark, they've already made back most of those losses. S&P 500, largest index in the United States, made up of 500 companies. That's up 14%. I mentioned that. And again, the S&P 500, the tech stocks make up the largest component of those 500 companies, or well over 30% now, depending on if you're counting information technology as tech or not, but definitely the largest component or sector of that indice. And that is helping, or index, and that is helping that index move significantly higher. The Dow Jones, as we know, Dow Jones Industrial Average is what we see a lot in the news, and that is really 30 stocks, only 30 stocks, and really to our portfolios doesn't matter an awful lot, but that index is up about 2.5% year to date. There's more of a balance in the Dow Jones. You have some bank stocks, you do have some tech, but you have other names, industrials, etc., and some of the other areas, as we saw earlier in the show, not faring as well. And last but not least, Toronto Stock Exchange, TSX. How is the TSX faring? Well, it is the worst performing index out of all the indices right now. If you look at them, and here you have a chart of the TSX, less than 2% growth so far year to date. And I think if we, pull up, you can see, I think we have a chart of the S&P. You can visually see how well the S&P has done. There it is there. And take a look at the NASDAQ. I think we have a chart of the NASDAQ again. We've seen this chart before. You can see how well it's done. But going back to the TSX chart, you can see that you really haven't seen much in the way of gains. And this kind of brings up, a point that I wanted to make when I speak about the indices at the halfway mark is a lot of individual investors like to compare their investment advisors' returns that they help them get with their portfolios, or just their portfolios' returns in general, to an index, right? You often hear, okay, well, you got to be able to beat the TSX or do better than the S&P 500 or the Dow or whatever index you're comparing the returns to, because most people say, well, if you can't beat the index, I can go out and buy, just an ETF that just follows the index, and I don't need an investment advisor to do that. So hopefully an investment advisor or a mutual fund manager or a hedge fund manager will beat the index. And I have a bit of a problem with that, because once upon a time when the indices were very balanced. So yeah, the NASDAQ pretty much, at least since I can remember, always favored tech stocks, but the S&P 500 was more balanced. Banking, or the bank sector, made up a larger piece of the S&P. The oil sector made up a larger piece. Retail sector, pharma, they made up larger pieces of the S&P 500. The S&P 500 wasn't dominated as much by technology as it is today. So you could say, okay, well, can my portfolio beat a balanced index. And the TSX, I guess, primarily was always favoring, financials or banks, materials such as gold and oil or energy. Those are the three sectors or the main sectors that TSX always seemed to favor. And those three sectors always seem to make up about 70 to 80% of the index. So it was always hard to compare against the TSX. But overall, the S&P 500, the S&P 500 to me has become an index that is heavily skewed towards technology. And to me, it's hard to say, can you beat the S&P 500? Well, the S&P 500 is technology for the most part. And so unless you have a lot of tech names in your portfolio, it's going to be hard to beat the S&P 500 or the NASDAQ this year. So comparing portfolio performance to the S&P, to the TSX, which is only skewed to three sectors, to the NASDAQ, is very difficult. Do you want to compare it to the Dow? Well, that's only 30 stocks. So when someone says, well, you need to beat the index, or you're just not worth investing with an investment advisor, a hedge fund manager, or a mutual fund manager, I take issue with that, because I think more and more it becomes difficult to beat the index. And some years it's actually very easy to beat the index, like last year, if you were comparing to the NASDAQ, which was down 30%, or the S&P 500, it was easy to beat because that was down 22%. And most individual investors didn't do as poorly as that. So comparing your performance to an index has become more difficult. I personally would say, has your portfolio meet your expectations? Has it basically met all the expectations that you set for it? Is it on track to reach your goals? And if the portfolio is on track to meet your goals, that to me is a lot more important than whether it beats an index that is heavily skewed in one direction or not. So keep in mind, these indices are no longer the way they used to be. And if you're looking for performance and what to measure performance on, measure it based on, is it meeting the criteria that you've set out when you first started? Are we on track to meet your investment goals? And if you are, I think your hedge fund, your mutual fund, your investment advisor is doing a great job. So China, we talk about China all the time. They're the second largest economy in the world. And what we're seeing in China really over the past, let's call it first 6 months of this year, maybe towards the end of even last year, is an economy that has struggled to gain its former glory. Once upon a time, China had double-digit growth, over 10% growth. Started to fade a little bit over the past few years, heading into COVID and what we saw during the pandemic, but they were always 7, 8, 9% growth. Well, coming out of the pandemic and coming out of some of those lockdowns that they had, their zero COVID policy, et cetera, China has struggled, and they've struggled to regain the growth numbers that they had prior. And what that country has done recently, and we have a chart on that here, is the People Bank of China, they've cut their rates. And you can see the one-year loan prime rate has fallen. And it's interesting, if you were to, not that we have this, but if you were to put this chart on top of the Bank of Canada chart, or even better, the Federal Reserve chart, these two charts would be going in opposite direction. China is cutting rates to try and stimulate growth, whereas the United States and Canada, we're actually raising rates to slow down growth, which is interesting. But what's happened out of China has actually helped us quite a bit. By China slowing down, it has helped because we aren't seeing the high inflationary data that we may have seen if China was going like gangbusters right now. We would probably see them importing a lot more energy, importing a lot more oil. We would probably see oil prices significantly higher, and that would cause a lot of inflation. We possibly could see supply chain issues still happening if China was their growth rates were extremely high, tough to get things out of China, et cetera. Now China is trying to export as much as they can. They're trying to alleviate supply chain gluts because they're trying to have better growth numbers. So their numbers are better, so their people can have more jobs, et cetera. So what's been happening out of China has definitely helped the West in some respects keep inflation down. And even though interest rates have gone up tremendously over the past year and a half. Imagine what would happen if China was growing a lot hotter or a lot more. We probably would be seeing inflation falling at a lesser rate or less fast than we're seeing it now. So a slowdown in China has helped in a lot of respects the fight against inflation. I think overall the businesses around the world are hoping that China starts to pick up the pace a little, especially businesses that do business directly with or in China. Starbucks comes to mind, Tesla comes to mind, Caterpillar, Apple, a lot of the semiconductors, the chip makers, whether it's an NVIDIA, a Micron. These are companies that hope that China starts to pick up in terms of their growth. I have a chart here on the Shanghai, which is the index in China. You can see how, I guess, poorly that index has fared over the last, I guess it's a 1 year number. We can see that China obviously hasn't fared as well as North American indices. So overall, slowdown in China has helped the inflation or the fight against inflation. But I think we're going to start to see the pace start to rise coming out of China. I think they're going to start to do a little bit better. And again, if you own stock or own shares of companies that do business in China, this will definitely help their share price. Bank profitability. I like to end our show right before we get to our questions for the show, talking about our banks. And our banks are, no doubt, they're struggling. Their share prices are down. They continue to increase dividends, which is great. We know that Canadian banks always seem to increase dividends every year, and that has never not happened since we've been keeping track. But bank profitability is down, right? As interest rates move higher, banks are being forced to pay out higher interest on their savings accounts, on their high interest savings accounts, on the GICs they provide. They're starting to see an overall slowdown in the economy. So people aren't borrowing as much as they were before. Businesses aren't borrowing as much. We're not seeing as much capital markets activity. A lot of companies aren't going public anymore. And recently, OSFI, which is the governing body for our banks, has forced our banks to increase the amount of money they've set aside for bad debts, for defaults. And I guess we could start off by showing some of the bank charts here. TD Bank, we can see that chart. You can see how much the TD Bank stock has gone down over the past little while, trading with a dividend yield now of almost 5%, something we don't see often. Another chart on Royal Bank, our largest bank. You can see that bank stock hasn't fared much better, probably a little better than TD, but not a whole lot better. And lastly, our third largest bank, so those are the two largest, third largest bank is Bank of Nova Scotia. You can see the Bank of Nova Scotia has not fared well. In fact, if you buy Scotiabank shares today, you would earn a dividend rate of almost 6.5% because their share prices have fallen. So to me, what is OSFI saying, the regulators? What are they saying by telling our banks to hold more capital in reserves for a rainy day or in case of default? Well, they're saying that they see defaults down the road, which in my opinion contradicts what the Bank of Canada is saying. Bank of Canada is saying we need to raise interest rates because things are too good. And on the other side, OSFI is saying, well, things are probably going to get worse, not better. So who is right? I guess time will tell. But overall, in my opinion, banks are having to hold more and more capital on reserve. And our chart we have here, one of our last charts, we talk about domestic stability buffer, and 3.5% of total risk weighted assets has to be kept on the sidelines. We know our banks hold a lot more than that. The chart on the right shows that our bank actual levels were 13% as of April 30th, 2023. So we can clearly see, and these are our top 6 banks that are systematically the most important banks in our country. They're being told they need to keep more and more on reserves. This is obviously eating into profitability at our banks, but make no mistake about it. I think our banks will recover once we get some stability in interest rates. Once the banks understand the environment they're in, you couple that with a good dividend and the possibilities for future growth. And I think these bank stocks still make sense for the average Canadian or international investor seeking growth and income over time. So this is the part of the show where I like to address some of the questions I receive. And I think we have time just for one question today. I know that I get a lot during the course of the 2 weeks, but hopefully we'll answer them on the next show. With interest rates continuing and projected to keep going up, am I better to buy GICs than invest in individual stocks? Great question. And I know a lot of individual investors would like to invest in GICs and high interest savings accounts because they are low risk, right? You make a 4 to 5% interest rate, and that is a lot higher than they were a year and a half ago, probably 1-2%. But again, it all comes down to what are your expectations? Are you looking for growth or are you looking for income? Can you handle a medium risk portfolio or would you prefer a lower risk portfolio? And I think that is probably the more important question. So it comes down to what you can handle in terms of risk, your investment objectives. What are you looking for? Are you looking for an 8 to 10% rate of return? Or are you looking for a 4 to 5% rate of return? And that to me should dictate the type of investments you have in your portfolio. So with that, I want to say thank you to everyone that tuned into the show this week. Obviously, we tackled a lot of great topics that I think can help everyone help you make your investment decisions over the next couple of weeks until our next show. Our next show will be on July the 12th, again, a Wednesday at 12 noon. And again, thank you for tuning in. And until then, happy investing.